Hello guys, it's CastAwayTrader. Welcome to our live stream. And this is my website www.castawaytrader.com. This is where you can subscribe to my service. And you can follow me on Twitter, just find CastAwayTrader. And before we start, I would ask you to read that important disclaimer. We are required by law to show you that text. And today in the video we will be talking about a reversal we got today on Wednesday on FOMC day, and just a brief introduction of the main method I use in trading. I use so-called harmonic Elliott Wave theory, which is a modified version of the Elliott Wave theory, and the main modification from the classic Elliott Wave theory is that every wave, either up or down, is subdivided into ABC. And on my YouTube channel, CastAwayTrader.com, I will add the link to my YouTube channel in that video. You will find several videos where I explain in details the main idea of modification. The very big picture is that we started a big rally in March 2009. And in my opinion, we topped in that 5-wave up rally in January 2022. And there are only two fractals, that means repeating patterns, that under the harmonic Elliott Wave theory and under the classic Elliott Wave theory actually describes all moves in the market, either on a minute chart, on a daily chart, on a weekly chart, on a monthly chart. We keep seeing the same patterns played again and again, and if we got 5-wave up that topped in January 2022, what we should expect? We should expect a corrective A down, B up, C down structure. And in my opinion, we are either somewhere here starting a large wave down, or we are somewhere here starting subwave C or wave B. But we will be able to talk about the big picture analysis later on in that same stream. And now I want to introduce you my dear friend Kyle. So his nickname is MarketMaestro, and in my opinion he is the most talented and the most professional trader who solely focus on ES mini, and he helps me in my chat room. He shares his ideas, his setups, and today we both were pretty active in my chat room, and he posted a lot of setups, and I guess he nailed like 187 points in ES. It's crazy. I'm not sure I will ever be able to do something like that. And this is why I want you just to listen to him, to his explanation. He also uses wave methods. He is a pro in what comes to waves and extensions. So I would like you, just to listen to him, and I would ask Maestro, just to start sharing and start your presentation.
Dennis and I are compatriots. We've been around each other for about 10 years, run in very similar circles, specifically in people that practice Elliott Wave. I do agree very much with Dennis's practices and procedures in regards to looking at harmonic Elliott Wave, not necessarily traditional. The reason is because too many people know about it, and 5-wave structures are always problematic. People try and make them fit, and really, most importantly, Elliott Wave practitioners, Elliott Wave theorists, believe in a set of rules, and I believe that's intrinsically wrong. Having rules means that you have biases, means that there can be violations that lead you to abandoning an outcome potential for a fractional issue. So in looking at larger market pattern structures, as you see on the screen here, you can see where we were at the low from 2009. I count this not as 1, 2, 3, 4, and 1, 2, 3, 4, 5, but rather A, B, C of A, B, C of B, A, B, C of C, topping pretty much in agreement with Castaway as well at the beginning of the year in January. Now, the issue that we find ourselves fronted with now in regards to the larger pattern is this. We've seen often in the subwave patterns, specifically in larger correctives, okay, B wave lows of an A, B, and a C of B come below where A had began. Now, if you look at the larger support structure that you see coming up, rising and been held for about 13 years now, you can see what the problem may be. So what the consideration is, considering we are right at that support, where price on major lows has responded, even in the 2020, hustling back over it very quickly, okay, try and find me an A and a BC pattern within this, and it's darn near impossible, especially looking at how large the C wave is. So that B of violation coming close to the A wave of larger degree, and then that fire out into C wave could really catch a lot of people off guard here. So as we're sitting here right now, we're discussing, the larger support, the larger move down. Okay, the supposition here, there's a few possibilities. One including A to B to C of B up. Okay, that's general standard practice. We could also see A to A, B, and then C of B that violates the A area, okay, and then takes off. This is my preferred, actually, because it would catch a lot of people off guard, and it would lead to the supposition, the belief within traditional Elliott Wave people and a lot of other market pattern traders that we would be in the first of the fifth, leading towards, supposition expectations towards 5,500 to 6,000 and change. Now, what that would lead to, the reason I think that that's a pretty good setup, okay, is that from here, retracing back A, B, they'd be seeing a 1, 2, okay, and expecting 3, 4, and 5. The problem might happen that what if that is that tricky B wave high, and instead we get A, B, C of A, B of C, the larger C, and then the larger C down. Okay, that would lead to, it was a 1, 2, 1, 2. This is the third wave down. We're going to Hades from here. All kinds of capitulation, and would set up very properly here to begin the final, because if it is an ending diagonal, they like to end where they start, the A, B, and C wave of the final degree, with potentially a new president, a new Congress, a lot of other things that on a larger standpoint would burn off a lot of the inflationary issues, would change the marketplace in a lot of different ways, and set everything up for a new regime. So with those considerations and concerns, we are in a very prickly and precarious spot, specifically if you adhere to traditional Elliott Wave. So for those reasons, that is exactly why I am very much in concert with Castaway's outlook that this is a more harmonic Elliott Wave structure than it is a traditional Elliott Wave structure in price pattern. Now, I wanted to go over really quickly what we had transpired today in regards to the Federal Reserve. I don't think anyone was in shock or awe that we had rose 0.75 basis points. That was pretty well known on the street. There was some hope that maybe because inflation hadn't grown as much month over month last month, it might have been a half a basis point. They might have been more dovish and accommodative. But really what happened today is it wasn't necessarily the rate up, in my opinion. It was the introduction of the longer term plan of how many rate ups to catch up it would take, meaning that they would not be accommodative anytime soon. So a lot of people that were, okay, This therefore should mean we should, um, we should expect this to be toppy as far as how much they're rating up. Okay, and maybe they won't be as serious about the quantitative tightening, i.e., moving their selves to liquidate into the marketplace that is quite soft. They're huge holdings in pretty much every sector out there. So I believe that as much as it was somewhat of a bullish setup today, the more that Powell talked, the more it became clear that one, the rates are going to keep going up, and two, they're very serious about selling things off their book in quantitative tightening and instead of quantitative easing. There really isn't much room left on the margins of debt, and reprinting is only going to exacerbate inflation. So that became all very clear very quickly, and I think that that's the result of what we saw today. Okay, getting back to things. We had a very kind of nasty, trolled out disruption on our Zoom. I guess that comes with some problems in inviting people randomly. We're going to get better at doing that for make sure that we're talking to our people, not just randomly talking to people on Twitter. I mean, some of these guys are just disrespectful and nasty while we're trying to actually share what we do here. So anyway, putting all of that aside, which you have to do often, put the haters away and get to business, we're looking at today. Now, earlier today, the structure looks very small here. I'm showing you my 2000 volume chart, which I utilize quite often. I utilize it because I like the congruency of the chart as opposed to on minute charts. You see large bars moving up and down as far as range is concerned and those things. And you'll notice that using a volume-based chart, you have a lot more smoother, congruent moves. And that works for me because I utilize a lot of indicators that are volume-based and volume-driven. Now, there are a lot of people that use time-based charts, and that's fine for them. I don't really concern myself with the time. I concern myself with the fleshing out of the larger patterns that I see. So coming into this morning, you can see what happened on the overnight. We had concern, Putin going to hit the mic. He wasn't going to do it until 2 a.m. We get till 2 a.m. It takes a dive, and lo and behold, same old, same old. Just happens to coincide as well with when Asia is coming to, the tail end of their market at about 5 o'clock with a 12-hour time difference from New York City, and the beginnings of Europe coming online. We've got a significant buy off of that low. We could see it crossing with momentum, okay? Crossing over the differential. MACD is showing that, we're getting some serious bid. We come into the morning. Now, just to give you guys an update, I don't trade anything until at least 10 a.m. Why? I don't like morning whips, and it takes a little while for the specific indicators that I use to catch up with the volume profile of what's going on with the day. Okay, so coming into that, we're grinding along here, waiting for the 2 o'clock hour. Okay, and as you can see here with the volume blocks, there's more sells than buys here, but price is staying supported. So the buys are basically, when I see a lot of sells coming in, they're more consistent than the buys. What that tells me is to support price, algorithmic systems are picking up at support and keeping the range. They buy exactly when they have to keep the range tight where they want it to as they're setting up their action. So as we got coming into the 2 o'clock hour, okay, there was also some concern that, okay, does everybody really want to hold into this announcement? I don't really think so. Are we going to go A? We came up to B. We didn't quite make a new high. Cross again on the momentum's, going lower. There were a couple decent scalps, but nothing to write home to. Or nothing to write home about, should I say. So this was a time to, set up, reset, take a look at how everything and get ready for what action would come. Now, I think CastAway made a great impression this morning, first thing coming into the day, saying that there would be about 5 to 6 whips, which there usually are. We also know that looking at the week, if we look at a longer term chart, I mention it quite often, that prices of interest really tend to happen in this 62 to 67 range, and we have been kind of stuck there for the last 3 sessions. So attraction towards that level, that's when a lot of people have entered, that's when a lot of people have gone long or short. There's a lot of action around that price. So supposition that if we're going to take a dive A to B looking down for C, that's a pretty good supposition that we'll revisit that area, potentially, leading into the Fed or directly after. The reason is, do they want to press the people that are in that position where they hold support and add to the market buy, or will they fail and sell? So moving forward into the day, okay, we came up to that same resistance, which they had already established this morning, okay, and we've got a major volume breakdown here, okay. You can see that here, and that was the first congruent signal, okay, that we would be looking to at least test that 62 to 67 area, okay. We went a little bit below it to test that low, rebounded directly to it almost immediately as well. So picking that, for lack of a better term, line in the sand where so many people had positioned turned out to be a good pivot point above and below the volatility price action that was going on today. So moving forward, okay, in the next few minutes, okay, we approached it, we violated, and yet it broke again. Now, what you'll notice here too is that the volume profile, okay, they call this the differential, okay, had reached a peak and was starting to fade, saying potential bounce. Okay, 1-2 off of the low. It's a great spot of entry. If you look at that, you're risking, for this much action to try and long it. It was 39 by 33, 6-point risk there with price action curling upward towards a crossing. So as price progressed moving forward, hit that same area, that 67, got rejected again. Okay, so you could have been pounding off of that 5-point range here pretty well into all of this volatility. I know it looks crazy. Okay, you get, a major move of 70 points. How is price, where and when is price going to respond? Okay, well, yet again, 1-2. Okay, are they going to lose that support they just threw a lot at, or will they return back to that area? Rejected again. Will they return back to that area? Again, now you have twice as much layered support there, okay? Again, it's telling you 1-2, your marginal risk is there, and by then you've clocked 20, you're really nailing them here towards support, gets to the area, breaks through it, okay? That tells you from this area, that was 6-point risk for 40 so far, blasted right through and following through topside after it retested that same range, okay? And at this point, okay, there was some major concern, okay, because we had A, B, and C. They were very commensurate in size. It was a very forced move, specifically this move over resistance, okay, was nonsensical considering what we had just heard. And we were going into, Powell getting a little bit more aggressive, okay, A to B, a little bit over the 100, but pretty darn close. Powell being a little bit more progressive and aggressive in his speech about we are going to continue this into 2023, giving 2-year out projections, as well as this is not the last rate up. Even though inflation month over month has been cooling, this is a concern. And it's a concern of a major degree. So people that chased it up to the 3,900 area, we had this area marked pretty well, broke above that resistance and almost immediately down below it, said, okay, we had a volume decline. We're waiting for MACD to cross over. You could potentially have said, okay, that was a peak. RSI was really high. To take that short turned out to be the trade of the day. Okay. Bounced very hard, trying to follow through. Again, 1-2. People were asking earlier today, what did we mean by 1-2? Okay, if you're looking at 1-2, the issue with 1-2 is 1-2 in the supposition is 3, but 3 wouldn't happen congruently. It would be wave 1, wave 2, wave 1 of 3, 2 of 3, and 3 of 3. That's why we say 1-2, 1-2, which would lead to the third of a third, which is a very vicious, impulsive downward leg. So as we started moving, we went 1-2, 1-2. Okay, and we were talking about that about here, and it started looking like a third wave, right? But then guess what? It came up, and in traditional Elliott wave, if any of the subdegree waves violate wave 1 territory, which would be the area of that count, you just destroyed the impulse, because the impulse would have just carried and carried and carried. So that brought into the focus there. Okay, A to B to C up, A to B to C down. Maybe we're going to go A to B to C up to a higher degree. That was the supposition. That was the impression that people that were counting the pattern waves were trying to induce. Not fooled one bit, because we were still embedded very deeply in the volume area. So following through with that, letting it ride, okay, until this materially crosses with momentum, proving that one side is taking control of the pattern. Okay, yeah, it came close. It did not cross. It continues to follow through. So that is essentially led to retesting the low of the day. Still got the same response. I mean, you have to think about the strength of the people who took the reins here and held that kind of action to make that kind of result. And the supposition there, A to B, maybe it's going to do C again. Okay, we've seen a lot of those kinds of moves, 50, 60, 70 point moves. Still, though, no crossover momentum. RSI on just this little bounce. Look at how high it got. They threw all they could at it, way too hard, way too fast, and momentum was against them. So you just stay in the short. Now we were coming into roundabout towards the close. Okay, we were holding this low, and I said, okay, the deluge is going to start, because if this breaks, whoever's been holding this thing up and throwing all of this ammo at it is going to join the concert. They can't hold it. Now, most of the time when you break a support like that, it's a serious dive kind of move. Not in this case. It was a slow trickle down, okay? Now, what was interesting here to me was that the buying had started. They were trying to shift momentum, but look at how thin the volume was. It was nowhere near the momentum to fight back against this move. So you started getting a capitulation. Capitulation. That capitulation continues. And the issue here that I see is this. I consider this A, B, and C, whether it's whatever count you want. Okay, we have 3 commensurate waves into a capitulation low that happen to come right around that 60s value again. That to me says issue. Secondly, I posted it on the site. The imbalance going into the Fed was about $2 billion. At last reading of it, let me take a look here. In one day, in one session, for 100 points. Okay, that's really what we're looking at, maybe 150 points. This is what's happened to premium across the S&P 500. We've gone into an imbalance of almost $50 billion. Now, to give you a semblance of what that means, at the highs and low peaks, the most I've ever seen is $124 billion in balance. And that was at the screeching peak, either at the top to the call side or at the low in 2020 to the bottom side. What that means is the underwriting insurance market is gushing money exponentially into put premium reward. And they have 2 options. They can pay out exponentially if it's that bad, if they truly believe that the bottom is falling out of the market, or they can induce people into these expensive contracts and start buying, because then at least they get an asset out of the deal, and they can shake off some of the money that has been rewarded to the put side. So at this moment, okay, coming into this place tonight, this was a 100-point range from the 60s to the 60s. But why did we land there? If you think about the 60s, okay, that's why I love them. From 62 to 67, you can imagine the next higher increment. You're imagining 3,800 as your next target. Okay, but the other part of it is it lands between, almost perfectly between two very big held strikes, 37.50 and 37.75. If you divide that 25 increment, it's 12 and a half. You add that to 25 or subtract it, or add it to 50 or subtract it from 75, you end up in this equally probable zone. Okay, so that hurts both strikes, the 75 above and 50 below, because you're equally probable to reach either. Okay, now we did that for 4 sessions leading up to this volatility, and it's no surprise to me at all that we are back at another value, one rung lower. Okay, but the exponential payout potential, unless the overall market conditions are just undeniably bad, everybody has to get out of everything. What they're looking at here, what people who write these positions are looking at here, is an exponential payout on something that happened in one day. I don't think that it behooves anyone to pay out 10 times what someone put in for a market this volatile that can move this much in liquidity that fast, especially if they know that they've got their finger on the heartbeat of it and they know that they can hit the gas and keep a good portion of the 50 billion in balance if they start buying and they get the assets out of the deal. So there's 2 major issues that I'm looking at here that would slay the traditional 5-wave counter that I think are worth considering. One is this: if I was a 5-wave Elliott wave counter, where's wave 1? I don't see 1, 2, 3, 4, 5. I see A, B, C. That's caveat number 1. I also see A, B, C, B small bounce, A, B, C, and we're at the 100, right about here. And this is a major inflection price point. Okay. Now, if you wanted to count this as 1, we're on the beginning of a massive C wave down, etc. Like I showed you earlier, if you violate wave 1 territory within that discipline, it's invalidated. Okay. So a 3-wave bounce from here, A to B to C, seems improbable. Is it probable this week? Maybe not. Taking some of the heat off of this dive down tomorrow seems to behoove the market, considering how skewed the basic insurance market against what's going on out there really is. Because if you look out there, it wasn't, a 5% to handle a lot of names. So the supposition to kill the impulse, I hate 5-wave counts. I look for every way to break them. The easy way to do it would be to go A to B to C. Now, will we complete that in one fell swoop tomorrow? Probably not. But to take 50 points back, gently possible. I could see the money motivation to do so. And if not, if the bottom starts falling out here at 37.40, 37.20, breaks 3,700, we're going someplace deep. Meantime, this was pretty tidy and orderly, if you ask me. This was not big drops. We've seen that before. That's not how this felt. Secondarily, a 3-wave bounce kills that impulse wave count. Now everybody's guessing going into the weekend, where are we on the count? And, if there's any possibility at all to do 50, come back 30, go another 50, and we get anywhere near this 38.60 area, the week is flat. Flat. If that gets pulled off, this was a gigantic money grab within range that we've already been chopping around in for weeks and weeks that everybody fell for. So within those concerns and conditions, that's where trepidation, that's where consideration of maybe this is too much too fast. How can people get really jacked on this? Because look, when it comes down to it, I've said this before, but I'll say it again. For a few people to win big, many people have to lose. That is a rule of the stock market. It just is. To win big on this move here earlier today, you had to knuckle up and buy when nobody wanted to. Meanwhile, if you were paying attention, that's the smallest risk to reward you could possibly get. Same with here. 1-2 short there after it just popped this hard up into there. Nobody wants to do that. But if you see the erosion of the momentum happening beneath the market, okay, it gives you a little bit more gumption to say, okay, that's my risk to reward area. I've showed that to you guys. I've tried to illustrate that the 1-2, the AB, okay, that turns, instead of long in here catching the knife, you got some proof, and you've got a decent supposition knowing, okay, this is my risk area, and if I measured this, as the move, I should get a commensurate move. And a lot of these, 1, 2, 3, or A, B, and C, you get something a lot bigger. Okay. But you got to knuckle up when nobody wants to. No one wants to buy right now. That might be the reason why you should. So look, I just wanted to go over how things had unfolded today and what was going on in my mentality. I can only speak in so many sentences with some text real quick about what I see, especially at the pace that things were going today. Okay, but I can break it down for you a little bit better in like a video like this, in hopes that you can understand the process and procedure. I know that it's a lot coming at you, and like today was definitely not a day for a novice, especially turning in or turning out consistently, maybe as fast as I might have been going, but I was in the zone, and when you're feeling it, you just flow. But I'm trying to be illustrative and helpful as best I can, and I hope that this has been at least a little bit of a supplemental enhancement to everything that transpired today. I try and post my entries, general targets, and stops. Some of them are good, some of them are great. It really depends. You have to judge them as they come. I don't pick large swing targets on anything that's moving. I know we have larger counts for swing trades, and I applaud everyone who can do that. I don't have that in me as far as my supposition of I will take on risk and buy when no one wants to, but I need to know that I'm on the right path. I will cut out early on my larger targets if I have any question about giving it back, because look, they're like buses. Waves are like buses. There's one around every couple of hours. There's no need to push yourself, to risk too much, to second guess, all of those things. They're not efficient, and they lead to the moment that you say, if this thing could just work out, or that it'll just get worse and worse. You're better off just going, okay, here's my shot. I'm taking it. I got decent profit. I'm walking. I walk. I make, I take, I make, I take. That's all there is for me in this business. It may be different for you. It's different for everyone. Now, the other thing that I wanted to discuss with you guys is I do this mostly with futures. I'm discussing all of this that you see in front of you with futures, okay? Because I like the immediate risk to reward, to return, to know what I'm dealing with. But as we reach the further ends of larger potential counts, okay, if I've done my job reaching that further end, then I can afford to start speculating a little bit more in options for a larger outcome, to a compound effect, okay? Now, options are a secondary leg to my trading campaigns on, I don't just trade one leg, I'm trading multiple legs towards the target, okay? So I get, a big move up, a big move down. Now, instead of going as balls to the wall, towards, this low here, I will start, okay, this was a great, productive, profiting leg, start layering into bounce potentials, or looking at the bid and the ask, more importantly, the ask price on spreads that are potentially in the money. Like for example, right here, I'd be looking at 3,800 by, 3,805, just trying to take as much front side credit with as little margin as possible. If I'm wrong, great, take a dollar, $1.50, which on a 10 spread would be 1,000, maybe 1,500, and try and squeeze some of the value out of those contracts as people who hold them are getting worried and losing value intrinsically, either by time or getting shaken out of them by spikes against them, and fading the move that way. And as I fade the move, great, I take that credit in and I apply it towards calls in case this move goes A to B. When B hits here, start buying the calls, because that's my risk area. I'll get rid of the calls if they get below there, and maybe I compound effect. Maybe I took credit in, the credit affords the call that no one believes in, because it's, they believe it's going to go down lower than here, specifically if if this goes deeper to here, start bidding the calls there, and then you can compound effect. Okay. It's a multi-stage, multi-instrumental process and procedure that I go through in trading daily. And then I look at shooting out a couple of weeks, maybe a month, to layer into what people aren't expecting, because no one values insurance until they need it. Okay. So I know I've taken a lot of time here. I just wanted to give you guys a larger picture of daily practice, the larger picture of where I think we stand in the marketplace, and just a little bit of insight and a personal touch towards my daily practices. I hope it was helpful. Please give me some feedback if you like, and have a great one.
Okay, let's come back to my screen, and I'll briefly guide you through basically what I expected today. And this is NQ mini chart. The idea was that we got a corrective rally that topped in middle of August. And off the top, according to the fractal or repeating pattern, we expected in general a 5-wave down move, as basically everybody else. So my idea was that point was made in mid-August, and the main expectation was that we are going to get 5-wave impulsive decline to new lower low of the year. But this is what we got. We got ABC down, and then that straight move up that topped on September 13. And frankly speaking, that type of structure does not look impulsive, because we, under the harmonic Elliott wave theory, we can count that ABC down as wave 1 down, but there is no any way how we can count that straight move up as wave 2 up, because wave 2 has to be subdivided into ABC. So this is a repeating pattern, we call it the fractal, and for example that wave 2, you can see it normally has a clean ABC structure. So then we would have two alternative scenarios. The main scenario, if we really want to continue counting the decline as an unfolding 5-wave down structure, then any 5-wave down structure has to start from 1 down, 2 up. And to complete the 2 up, we still needed a push up, because if we had a considerable push up, at least 76.4% of that push up, we could count it as A up, B down, and C up of a corrective wave 2. But that was my primary scenario. But by Monday, I started to doubt that, because the market just refused to go up. And I started to consider a scenario where the straight move up was so-called wave X in so-called WXY double 3 corrective structure. And double 3 corrective structure is just a combination of two ABCs. ABC, this is the first ABC, then the straight move up in X, and another ABC down. What you need to remember about any double 3 corrective structure is that so-called technical wave X is in fact a failed attempt of bulls to start a new rally. Because basically every time we get a corrective ABC, for example here ABC, making a high low, it's a great foundation for bulls to start another ABC up. And that ABC down would need another ABC up to start continuation, another leg down. The only exception when we get so-called double three corrective structure and that push, straight push, and I never trust straight pushes, and today basically was a great case where demonstrates that rule: never trust straight moves that lacks any ABC structure. So when we were expecting an FOMC day as today, so this is Monday, 2 days before FOMC, my primary scenario would be to get ABC move down according to the repeating fractal I keep watching in the market. And here the problem for bulls was that NQ drove head and shoulder structure, and that head and shoulders was triggered when price dropped under 12,150. So this is why you see it used to be green band, demand band, and it turned into support one. So the first problem for bulls, the first task would be to recapture that level, and once we recapture it, they would be able to push higher. And here you see retracement ratios applied to that decline. So everything was going well because we got ABC up and we got B down that found support in a green box and it made a high low. So that was a clean scenario for another push higher in subwave C. And this is Tuesday 8:40 a.m. This is when I normally start posting updates in my trading chat room. So by 9:30 the price was still hanging in that green box. And I suggested a modification. I said that most likely we would get more whipsaw, we would get another push up into the red supply zone and another rejection and probably double bottom on a higher low, and then the final push higher into the red target box. And the whole idea was that that was supposed to be subwave A, that was supposed to be a corrective pullback in subwave B, and in any case we expected another leg down in wave C that would drop under 11,800 under the previous low made by wave A. And this is how the things changed by the end of the day on Tuesday yesterday. So we were still hanging around that green box, and we started to get a move up, which started to look like one up, two down micro scenario. And in addition to that, it looked like an inverse head and shoulders, a micro head and shoulders trading setup. And it's great when we have a setup confirmed by wave analysis, which at the same time is considered as something more traditional, like head and shoulders, double top, triple top, something which is recognized by millions of other traders who are not professional, for example, to use wave analysis, because we are in self-prophecy business. So if we recognize a pattern, it works not because it has some magic values, but because some people, when they see that, they expect specific action. So when wave analysts and traders see so-called one up, two down setup, they always expect a rally. And the most obvious target for the rally was that same red supply zone around 12,100. And this is how we started the day. So this is September. And Q-mini is the same chart, 8:45 a.m. and we got overnight that push higher. You may ask me what is that moving average? It's 500-day moving average, simple moving average, and that pinkish line is 200-day moving average. So we got that first push higher. But the idea was that that was a corrective A up, which itself is subdivided into ABC, B down, which is itself subdivided into ABC, and in corrective structures, normally subwave C, the second leg up. is supposed to be subdivided into 5 microwaves. And that push up could not be wave 3, so my understanding was that it would be subwave A of 3, and it was supposed to be followed by a flat consolidation. So we got that push down, and that was it started to look like a good setup to a bigger push up into 12,100. But time we spent like another 2 or 3 hours. It's 1:20 p.m. So at that point we had 40 minutes before FOMC announcement, and we got, you see, that crazy whipsaw, very flattish whipsaw. It looked amazingly well, in my opinion. I thought, like, it's a great opportunity to go along, and I personally bought here TQQQ SPXL. Unfortunately, we got that consolidation, and the first reaction was bullish. It started to push higher, but it did not hit the target, the very first target, the red band. Instead, it dropped under the stop. And that was that spiky move down. And this is what I paid attention to my subscribers, is that that week, this is what Kyle was talking about. We had several cases when price would drop under the previously made low, apparently an important low where many people would leave their protective stops, only to get bought and only to get pushed back up and produce so-called failed breakdown pattern. And that was one of those cases. This is what I wrote to my subscribers, is that was one of those cases that probably we deal with another failed breakdown setup, meaning that that's another potential for bulls to finally push higher. And that was my next update at 2:18 p.m. And you can see price dropped and stopped a little bit higher than that important support, and this is where I had to change my count. I could not longer count it as start of subwave C of wave B, but I had to count that whole structure of the top made by the first ABC as a larger ABC. And this is a deficiency of the method, because we could count that ABC down as B, and that move up started as a promising start of wave C, but instead on FOMC we got an emotional spike down. But at that point I considered the drop as an attractive long setup, and we could put a stop right under the low. This is what happened then. Let's see. We started to get a bullish reaction, a very strong bullish reaction. You see, I mentioned to my subscribers that if we get a push back up over 11,861.50, which is used to be a stop for bulls, a protective stop, so if bulls manage to recapture that low, that would be a bullish setup. That would most likely mean that price goes to a new higher high. Let's come back to the chat room, and this is what we got pretty soon. So that basically happened at 3 o'clock p.m. Price spiked into the red zone and it got rejected. And this is where I counted that whole spike as subwave C of wave B. So the rule of thumb is that every time you get the second leg, which looks like a spike, most likely in 90% of cases, it would be a completion of some corrective structure. Look, we got A down, B up, and then spike. So my conclusion, it's C down of a corrective structure. If it's ABC down after ABC up, then it's wave B. And then we got a spike, which is supposed to be subwave C. If we consider that we got A up, B down, then the logic tells us, okay, this is a completion of that A up, B down, C up. So that may look very complex, but in fact, it's basically one and the same pattern. It's the same ABC. You just get that A up, B down, C up, where B itself is ABC and where A itself is ABC. But wave C itself normally is either structured as 5-wave structure or just a spiky push higher. And once we topped here, that was a great opportunity to load up on shorts. I shared in my chart room 2 scenarios with long-term dated puts, SPY and QQQ, and it's funny that we could actually count those puts. So this is the initial link where I posted them. I posted that chart that actually attempts counting waves on not ES mini or S&P, but on price of put options themselves, and it had a very clean structure because it got 1 up, 2 down, A of 3, and then we got a complex consolidation of subwave B. So that was a setup for push up. And I posted it at 257. I posted October SPY puts look interesting and looks like an inverse head and shoulders on QQQ puts. The same story. We got 1 up, 2 down, A of 3, and then very complex whipsaw of B of 3. But you should note that that corrective looking structure, you see it's overlapping, it's like a whipsaw. Every time you see a whipsaw, it tells you it's a consolidation that would be followed by another push in the same direction. So we got into that whipsaw going up, so that means that once that whipsaw is completed, we would get another push higher. And in addition to that, I added retracement fibs to that push up, and it stopped right at 61.8% retracement, and we can see what happened to those puts actually by the end of the day. I posted those charts. You see, this is exactly the point where I posted the chart, and look at that push high. And I should tell you that it could not be the top because we can measure that leg, and that leg should be at least 123.6% extension of that leg. So most likely that move up would continue over 11 for QQQ puts. And let's see SPY puts, we can see the same. So that was A of 3. So that push up should be bigger than that push up, so it should go well over 11 or 12 in my opinion, and we are talking about October 21st puts. And let's come back to NQ chart. You may know what happened then. So once we spiked to that red supply zone and we got those high tails into the red zone, then price turned down strongly and started to drop. And once we get A down and completed whipsaw of B up, we expect wave C, which should be bigger than wave A. So there's no any way how the drop could stop there. So it had to go deeper and deeper. And you know that by the end of the day, it kept putting down and kept going down. And this is how NQ 240 minute chart now looks like. So what we got ABC down, then that technical wave X, and then we got so that was the first ABC, and of that point we are supposed to get the second ABC. And that whipsaw we got very flat one. You see the same neckline. Bulls tried to break over that level twice, and both times they failed. And that spiky move up on FOMC, it prepared the same failed breakout setup. So we had two similar setups on one day. We got first a similar failed breakdown, very strong push up, and then failed breakout, reversal of the reversal. And you can see that we close the day with a large red candle with tail on top, showing that at that level there were very active sellers. And what's important is that whole ABC push up made a much lower high even than that high and that high. So we are seeing on the chart, 240-minute chart, that price started to trend down, meaning that every new low is lower than the preceding low, and every new high of any corrective pullback is lower than the preceding pullback. And in my opinion, so at the very least, price of NQ would drop under June 2022 low, and it may even extend to 10,800 to 10,650, and this is where we may get an interesting opportunity, because we would get a completed double 3 corrective structure. Even if we make a slightly lower low, that could be another major failed breakdown setup. So if we break under June 2022 low, and if in a matter of days bulls would be able to push it back over 11,100, we would get a potential macro setup for another large corrective rally, which would be able to go up at least to the top we got in August. And that would be a large A up, B down, C up corrective structure. Again, it would be a corrective structure. Again, I would not be expecting that we would get a new high over January 22 highs, but we could get a complex ABC structure. In the end of this stream, I would like to show you probably the most important chart, and I will share with you my long-term forecast for ES Mini. I think the whole market, all Elliotticians, we are going to make a big mistake because we incorrectly count that move down. Look at that pattern again. I told you that once we complete 5-wave up structure, we normally get a corrective pullback that follows. And in many cases, the ultimate target for that second leg down would be to retest the low made by wave 4. And that wave 4 bottomed in March 2020. So this is so-called pandemic low or flash crash low. Now let's come back. Now let's look at ES Mini daily chart. We got ABC move down, and it was followed by ABC move up. And many people, and I used to be one of those, thought that push up was a large wave B, which was subdivided into ABC. But look how small that wave A. And the wave theory requires us to work up a count where all waves are proportional. What that means is that wave A should be somehow proportional to that wave A, and it's not anywhere proportional to that. So this is why, and not only why, but another reason is the microstructure of that decline. I think that we are actually dealing with a little bit different corrective structure. So this is what the market expects. We believe that wave A bottomed in June 2022, and I agree with that, and they consider the top made in August as a large corrective wave B. And because of that, they believe that we have just started a huge wave 3 down. I think they are wrong. I think we are dealing with Z structure. Under Z structure, Z corrective wave B, or in this case wave X, has not topped yet, and we have not started yet the second stronger leg down. This is what we call double 3 corrective pattern: 3 down, 3 up, and 3 down. And under that structure, we are not going to get a huge drop here in wave 3. Here we are going to get 3 wave down: wave W, wave X, which got completed, and ABC down, where we have already completed A down, B up, and we are working on C down with ultimate goal somewhere in that green box. Most likely price would undercut the low made in June, but if bulls manage to push it back over 3,655, they would trigger another failed breakdown setup, a long setup, and when they push over that level, we could get a 5-wave up rally, bear market rally, into 4,200 something to retest that blue trend line from below and stop at 50% retracement or maybe 66.7% retracement of that first move down. And that would be 3 down, ABC down, 3 up, ABC up, and this is only when the second large leg down would start. So we would get ABC down, ABC up, and this is where we would start either 5-wave down or 3-wave down. And that second part of that move down would really come as a very strong decline, but that would most likely happen only in 2023. In description of this video, I will post a link to my recent webinar where I explain main difference between the harmonic Elliott Wave theory, the one which I use, against the classic Elliott Wave theory. You can also read a lot of articles I wrote about the harmonic Elliott Wave theory and its advantages for traders if you go to medium.com, and you can find me there. You can just turn any article, so you need to find medium.com/@CastAwayTrader. Again, I will post that link in the description of this video. If you seriously decide to learn that method of forecasting and trading, I would recommend you taking one of my courses. So you go to my website CastAwayTrader.com/education, and if you have some understanding of wave analysis, I would recommend you to start with that course. That video course is called Predict the Market with the Harmonic Elliott Wave Analysis, and you will have to pay only $69.99 for a lifetime access to hours of videos and more than 140 video lessons. And once you're done with that video course, I would strongly recommend you to take the next one of advanced level. That video course is called How to Trade Like a Pro, How to Use Wave Analysis to Find Winning Trading Setups. Again, it doesn't cost a fortune. It's only $79.99 lifetime access, and you will get access to 70 plus videos, more than 9 hours video on demand. You can subscribe to one of my plans. You can start with the cheapest one, which costs only $149.99 for 3 months. So it's less than $50 a month, but it only covers ES Mini. I always strongly recommend people to consider that plan, which is a little bit more pricey, but it includes coverage of NQ Mini and RTY Mini. And as I've shown you many charts in that video, I took them from my chat room, and I have several folders where I post charts for different instruments like AS Mini, NQ Mini, RTI Mini, and you will be able to see them in organized waves because I keep discussion separate from charts in different folders. So you will be able to quickly find those charts and look what I expect. Finally, if you want to get the full coverage, you should consider the full all-inclusive access either on a monthly basis, or you can save a lot by subscribing to a quarterly plan. Thank you very much for your time, and please like this video. It will help other people to find me and my work. And subscribe to my YouTube channel. I try to post videos regularly, so if you want to get notified about my new videos, please subscribe.